Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
Okay, so let's jump right in. AMC Entertainment, early January 2026. The stock is defined by this really deep and volatile tension. Right now, we're watching it trade in a pretty narrow but, I'd say, fiercely contested band. It's somewhere between, $2.27 and $2.33 a share. That puts the market cap in a place that's fluctuating, rapidly between about $820 million and $1.2 billion. And that intensity, often on high volume, it really reflects the central question here, the survival versus revival paradox. My position is, it's pretty clear. I think the company has executed a value-maximizing operational pivot. They've successfully navigated the liquidity crisis that really defined 2024, and now we are seeing the signs of a credible revival.
See, I find that price action reflects something else entirely. It's less about momentum and more about perpetual uncertainty. I just come at it from a different angle. That volatile price band doesn't signal a company preparing for revival to me. It reflects a financial vehicle that's just fundamentally constrained by these continuous, overwhelming structural demands. I'd argue that no matter how successful the operational turnaround is, and look, I'll grant you there have been some significant improvements, the colossal debt burden and the persistent existential threat of dilution, it just defines this stock purely as a constrained survival narrative. The equity tragically functions more as a funding mechanism for the debt holders, not as a claim on any kind of sustainable shareholder earnings.
Well, let's establish what management has actually achieved, because the structural improvement is frankly undeniable. The operational side has completely shifted. Their AMC Go plan, that pivot, is successfully transitioning them to a yield-based model, which, let's be honest, is necessary given the secular decline in theater attendance across the whole industry. This premiumization strategy is working. We saw it in the second quarter of 2025. Consolidated admissions revenue per patron hit a record $12.14, and crucially, food and beverage revenue per guest also hit a record $7.95.
Okay, those are excellent numbers, I'll grant you that. But what's the implication? The implication is that they are fundamentally insulating their top line from lower foot traffic. They're making more money from fewer patrons, and that generates really high operating leverage. That operational strength gave them the credibility to execute the most critical move they've made, the July 2025 refinancing. This successfully extended a huge amount of their 2026 debt. We're talking between $1.6 and $2.45 billion, pushing that maturity wall all the way out to 2029 and 2030. That bought them critical operating runway. It removed the near-term bankruptcy risk that was priced into the stock for years. And look at the market. Wedbush Securities raised its price target to $4, citing this improved debt profile. That suggests a potential 75% upside. That is a clear trajectory toward revival.
That's a compelling argument based on the maturity, sure, but I would frame it very differently. You bought time, but at a punishing price. The, $8.19 billion total debt load, that remains the primary unassailable obstacle. It's a burden so disproportionate that it fundamentally handicaps the company. Just to contextualize that massive figure, their closest, and I'd argue healthier, peer, Cinemark, carries only $2.96 billion in debt. So AMC is 3 times more leveraged. And that high debt forces this continuous financial engineering, and that has a very visible cost. The shareholder approval in December 2025 to double authorized shares to 1.1 billion gives the board roughly 550 million shares of what the market correctly sees as a massive dry powder overhang. This is the structural headwind that caps any sustained rally. Any operational success, any breathing room is just immediately used to issue more equity and funnel the funds to debt.
But isn't flexibility in a distress scenario a sign of responsible management?
It's responsible management for the enterprise, yeah, but not necessarily for the equity holder. And we haven't even touched on the crushing cost of the debt itself. The refinanced debt is expensive. Those new term loans have a floating rate of term SOFR plus 600 to 700 basis points. For listeners who aren't familiar, SOFR is the Secured Overnight Financing Rate. It's tied directly to Fed policy. So when you add that huge spread, you're looking at an effective annual interest rate somewhere between 9.77% and 10.77%. That is a crushing cost of capital. This high interest expense just aggressively consumes their adjusted EBITDA, preventing any capital accumulation at all. So yeah, you bought a runway, but the company is running on a high-speed treadmill just to keep up with the interest payments.
I think your interpretation of the dilution, specifically the use of those at-the-market or ATM offerings, is just far too negative. You highlight the sales in late 2025 and January 2026, where they sold 50 million shares, raised about $183.8 million, and then used it to repurchase debt at a discount. You frame this as damaging, but we have to acknowledge the systemic benefit.
I disagree. It's fundamentally damaging to the stock.
Wait, hold on a second. That dilution was the surgical procedure they needed to mitigate the explicit bankruptcy risk that was hanging over the company in 2023 and 2024. You cannot have a revival if the company doesn't exist. That authorization to dilute gives management the necessary flexibility to proactively manage that massive debt wall. Successfully deleveraging, even if it comes at the cost of the share count, is the highest form of responsible capital management in this specific scenario. It stabilizes the entire enterprise, which ultimately benefits the remaining long-term shareholders by ensuring there's a viable company left to own.
Okay, I grant you that the $183 million raised was value accretive for the enterprise. I mean, that's indisputable corporate finance. It reduced principal and interest. But the mechanism itself creates a structure where any equity upside is perpetually diluted away. The minute the stock price shows strength, the company can deploy the remaining 550 million authorized shares to fund more debt reduction. This isn't just debt servicing. This is a permanent value transfer from equity to debt. It means the benefit of operational success, that record $12 per patron you mentioned, will always structurally accrue primarily to the bondholders, not to the common shareholder. That's the core conflict of the survival thesis.
And this tension leads us right to the market's valuation, which is the most difficult part of your thesis to really incorporate. If AMC is merely a struggling survival story, why does it trade at such a remarkable premium?
Because of sentiment, not fundamentals. It's more complex than just sentiment. I mean, consider the numbers. AMC's trailing 12-month EV to EBITDA multiple is 23.6. Cinemark, the peer we discussed, trades at 9.2. Fundamental analysis would dictate that a company with vastly higher leverage and net losses, remember that $4.7 million net loss in Q 2025, should trade at a discount, yet it trades at nearly 3 times the multiple of its profitable peer. The market is pricing in something real here, something I call distressed optionality. The equity is acting like a highly leveraged, cheap call option on an unexpected box office recovery or a short squeeze supported by that psychological price floor from the ape investor base. Okay, let's talk about that option structure.
Yeah, exactly. Look at the options market. There's significant open interest in the $3 call strike for January 2026. This creates what technical analysts call a gamma cliff. And to put it simply for our audience, this is a technical price point where market makers who sold those calls are suddenly forced to hedge by rapidly buying the underlying stock. If momentum pushes the stock towards, say, 280, that hedging could accelerate the price upward. That speculative optionality is baked into the 23.6 multiple. The market's paying for that potential.
I'm sorry, I just don't buy that the investment thesis should rest on market mechanics like a gamma cliff. That's speculating on volatility, not investing based on intrinsic value. And while I absolutely acknowledge the mean premium exists, this valuation disparity is a massive, flashing red flag for any fundamental investor. The premium is rooted purely in a sentiment that is frankly eroding. We're seeing a growing faction of retail investors becoming realists, or maybe the disenchanted. They are tired of seeing their holdings diluted to service debt, and that whole diamond hands narrative is being severely tested by the stock's negative 60% one-year performance. And plus, if you want a true squeeze, you need friction. The cost to borrow AMC shares is extremely low. It's hovering around 0.45%.
And why is that so important?
Because that low cost to borrow just dampens the hard-to-borrow short squeeze thesis entirely. Short sellers are under basically no financial pressure to close their positions. They can just wait for the next dilution event. which they know is coming. So that 23.6 multiple, it's not optionality, it's fundamental mispricing rooted in psychology, which, unlike $8.2 billion in debt, is a fleeting, unreliable asset.
That's an interesting point. But I would frame that retail ownership not just as a market anomaly, but as a unique operational asset. It provides a stability floor most distressed companies just don't have. But let's pivot away from that and address the financial structure's vulnerability to external forces, a point you raised. You rightfully pointed out that the floating rate debt linked to term SOFR means a higher for longer rate environment directly sustains that, $100 million annual interest pressure per billion of debt, which suppresses free cash flow. That is a fact. But that blade cuts both ways. And the floating rate structure is also a hidden source of potential massive upside.
How can a crushing, near 11% interest rate be considered an upside?
Because the massive debt load creates extraordinary financial leverage against monetary policy. We have to consider the potential macro tailwind that many analysts are still anticipating, aggressive rate cuts by the Federal Reserve in 2026. Given the term SOFR linkage, a significant, sudden reduction in the benchmark rate would provide a massive, instantaneous tailwind for AMC. It would immediately reduce their annual interest expense by hundreds of millions of dollars without them having to sell a single extra ticket. This is where their high operating leverage becomes so powerful. If the Fed acts, the cash flow improvement is immediate and dramatic.
I acknowledge that potential, sure, but relying on a speculative external macro event like aggressive Fed cuts as your primary catalyst for cash flow, that just underscores the inherent fragility of the balance sheet. You're basically hoping for central bank intervention to save your cash flow statement.
But they're not just relying on the Fed. They're actively seeking new revenue streams that are less rate sensitive. We've seen aggressive diversification efforts. They're launching retail popcorn in supermarkets. They launched that $29.99 annual popcorn pass in late 2025. These are high-margin ancillary revenues that are far less sensitive to macro swings and directly help offset those massive fixed interest costs. They're building a moat of stable cash flow.
Efforts are smart, absolutely. But that $8.19 billion in debt requires relentless, consistent cash generation. And a company that's only generated a 13% adjusted EBITDA margin, it just can't afford to have its operational improvements held hostage by monetary policy. Any delay in rate cuts, or worse, any further tightening, pushes that interest expense even higher. It's a game of chicken where the equity holder has all the risk and the lowest potential reward. Because of that 550 million share overhang, operational excellence is being channeled entirely into debt service, not shareholder returns.
My core position remains that management has established a viable, stable operating model. It's built on premiumization, on record revenue per patron figures. They've secured a crucial operating runway, pushing that debt wall out to 2029 and 2030. So the revival thesis is now contingent on the 2026 content slate, allowing that high operational leverage to fully manifest before the full authorized share count becomes too restrictive. They've weathered the storm, they've stabilized the ship, and now they're positioned for potential market share gains.
And my position remains that the underlying financial structure is just fundamentally fragile, regardless of how many $12 tickets they sell. The $8.2 billion debt load and the $1.1 billion authorized shares ensure that operational improvements, no matter how impressive, are consistently funneled towards servicing past leverage, perpetually diluting the equity holder. The stock is best viewed as a speculative vehicle, dependent on volatility, sentiment, and the hope of external macro events, rather than a defensible claim on sustainable profits.
Ultimately, the tension that has defined this price action in early 2026 remains perfectly balanced. What this really reveals is that while AMC has demonstrably improved its core operational profile, the outcome for the equity holder is still balanced on a razor's edge. It's between the cash flow generation from a strong 2026 box office and the massive fixed cost burden imposed by that high floating rate debt.
Indeed. The listener is left to weigh the record operational efficiency, like that $12.14 revenue per patron, against the overwhelming structural reality of having 1.1 billion authorized shares hanging perpetually over the market. There's certainly more to explore and how these mechanics affect the company's ultimate ability to generate true shareholder value.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.